Hey guys, it's Mike with Financeable here. It's Friday, which means it's time to answer the weekly challenge question. By the way, if you like these videos, definitely hit the like button down below and subscribe. We've got a lot more coming. Let's hop in here. So this week's question is an accretion dilution question, but as was the case with some past questions, we're going to flip everything and think about the accretion dilution in terms of yields. So the question here is, Company X buys Company Y for $37.50 a share. Company Y is expected to generate $1.25 per share of earnings. Company X is going to fund the deal half with debt at a 10% rate and half with cash at a 0.5% rate. Assume both companies have 20% tax rates. The question is the deal accretive or dilutive? So that's the question. Let's hop in here. So let's start by figuring out what yield we're going to get when we acquire Company Y. So we'll start on the right-hand side here. So we're buying Company Y stock at $37.50 a share. Company's expected to generate $1.25 a share. So we divide those two to get to a 30 times price to earnings ratio, and we're going to flip that ratio. So we'll take 1 divided by 30 to get to a 3.3% yield. So this is a public company deal, and when we acquire Company Y stock, we're going to receive this yield. So our financing cost has to be below that yield in order for this deal to be accretive. So now let's move over to Company X and look at our financing. So on the financing side of things, we have a 10% cost of debt for our interest expense that we're funding the deal with, a 20% tax rate. Our after-tax cost is the cost of debt times 1 minus our tax rate. And then down below, we have our cost of cash or foregone interest income, which is 0.5%. And our tax rate is 20%, and we have to calculate that on an after-tax basis as well. So we'll take the 0.5% times 1 minus our tax rate here. And now we're going to pull the cost of debt and cost of cash down to figure out what the blended cost of financing is for this deal. So we'll pull in our cost of debt, pull in our cost of cash funding, and then they're 50-50, so we have to multiply these out. So we'll take 50% times 8%. And then 50% times 0.4% to get to a blended cost of 4.2%. Down below, we're going to pull in the yield that we're going to generate when we buy Company Y. And our cost of funding is 4.2%. So we end up with a negative spread here, meaning the yield that we're going to receive is actually less than our financing cost. So the answer to this week's question is that the deal would be dilutive. Now, caveat here is that this is a bit of a simplified approach. In real life, there are a lot of puts and takes, but you may get a question about yields in interviews related to accretion dilution, and this is how you tackle that kind of question. As always, thank you so much for taking the time to check out our videos and for participating on the polls on LinkedIn that create these videos. If you found this video helpful, definitely hit the like button down below and subscribe. We've got a lot more coming. Hope you have a nice weekend. Take care.